Most companies chasing the AI boom are already dead. They just don't know it yet. They're spending billions, burning cash, and praying they survive long enough to matter. Almost none of them will. So when a company shows up and starts breaking records in the middle of that bloodbath, you have to stop and ask, how? Because here's the problem. In AI infrastructure, the gap between first place and second place is massive. The leader wins, everyone else fights for scraps. NBIS just made a move that put them on the map in a way almost no one saw coming. And if they keep this pace, they don't just survive, they could become almost impossible to compete with. But that's a big if. And if you get this wrong, you're buying into hype that will eat your portfolio alive. In 90 days, NBIS went from $55.3 million in revenue to $105.1 million. That's a 106% jump quarter over quarter. Year over year, it's up 625%. This is not normal growth. This is hypergrowth. And they're not just growing revenue. They raised their annualized run rate guidance from $750 million to as high as $1.1 billion by the end of 2025. That's the kind of confidence you only put out when the pipeline is strong and the customers are locked in. The AI infrastructure market is exploding, and they're moving to capture more of it. But here's the catch. Fast growth at this level can hide problems under the surface. Scaling this quickly means higher costs, more complexity, and bigger execution risks. We've seen companies double in a quarter before and then stall out when they hit operational limits. The real question is whether NBIS has the foundation to keep compounding at this speed without breaking. You see, anyone can rent GPUs and call themselves an AI cloud provider. That's why most of them fade out fast. NBIS is different because they own more of the stack. They're not just buying hardware, they're building the software, the orchestration tools, and the partnerships that make it all work together. They've got early access to NVIDIA's Blackwell Ultra platform. They're one of a handful of companies on the planet with reference platform status from NVIDIA. And they're integrating deeply with high compute sectors like biotech, AI research, and media production. The customers who can't afford downtime and won't risk switching. And they're integrating deeply with high compute sectors like biotech, AI research, and media production. The customers who can't afford downtime and won't risk switching. That's the moat. The deeper the integration, the higher the switching costs. Once a customer runs their most important workloads on your platform, they don't leave unless you screw it up. NBIS is locking in those relationships now before the competition can catch up. But growth like this comes with a price. In quarter two, NBIS burned $167.7 million in operating cash. On top of that, they spent $510.6 million on property and equipment in a single quarter. That's over $500 million going out the door to expand capacity. This is the trade-off. They're racing to secure more than 1 gigawatt of power by 2026. That scale is expensive, and in AI infrastructure, you have to build before the customers arrive. If demand slows or financing tightens, those bets can turn into liabilities fast. For now, they have $1.68 billion in cash and a strong balance sheet. But if this burn rate keeps up, they'll need more capital. And in a high-interest market, raising that money will not be cheap. The moat is real, but so is the bill. On paper, NBIS reported $502.5 million in net income from continuing operations this quarter. Sounds like they've already cracked profitability. But here's the reality. $597 million of that came from a one-time revaluation gain on investments. Take that out and the story changes. The real operating measure is adjusted EBITDA, and that's still negative $21 million. The good news is that's a big improvement from the $58 million loss last year. They're moving in the right direction, but core operations aren't generating consistent profits yet. This is the moment where investors get fooled. Big headline profits driven by accounting gains make it look like the business is a cash machine. But the underlying cash flow says they're still in build mode, not harvest mode. Until operations alone can fund growth, profitability is still an open question. The bull case is simple. NBIS is one of the fastest growing AI infrastructure providers in the world. They've got a proprietary tech stack, elite partnerships with NVIDIA, and they're expanding global capacity to over 1 gigawatt. The switching costs for their customers are high, and the market they're in is exploding. The bear case is just as clear. They're burning massive amounts of cash to grow. Their profits this quarter came from a one-time accounting gain, not core operations. And if capital markets tighten or AI demand slows, this growth could hit a wall fast. This is not a safe dividend-paying stock. It's a high-upside, high-risk bet on AI infrastructure dominance. If you believe they can keep scaling without breaking and reach operational profitability, it's a potential multi-year winner. If you don't, it's a money pit waiting to happen. So here's the real question. Is the business getting stronger every quarter? Yes. Are the numbers trending up across customers, contracts, and revenue? Yes. Is the product becoming harder to compete with? Absolutely. That's exactly what you bet on. My thesis is bullish and I'm putting my money behind it. I've been selling puts because I want to own the stock. If it drops, I get in at a lower price. If it holds or climbs, I keep the premium. Either way, I'm building my position. This is a high-risk, high-reward play. I'm not pretending it's safe. The growth is real, the moat is real, but so is the cash burn. That's why I'm scaling in, not going all in on day one. In a market full of AI hype, NBIS is one of the few companies actually delivering numbers that back up the story. If they keep executing, this could be one of the biggest AI infrastructure winners of the decade, and I want to be holding shares if that happens. Let me ask you something. Who else is breaking down NBIS's real growth story? The moat in their AI cloud stack, the cash burn risk, the exact option strategy I'm using to build a position, while actually showing you how to execute it in real time. Who else gives you both the bull and the bear case, shows you the thesis, and walks you through how to put your own money to work with conviction? Nobody. That's why NBIS is on my buy list right now. I've been selling puts because I want to own it, and I'm using that premium to scale into high conviction investments. And it's not just me. Steven just locked in $3,510.77 in premium income in a single week, his personal best, by following the data, analyzing charts, and managing risk. He made more in 1 week than he used to make in half a month. Queen of Me picked up 100 shares of NBIS on a cash-secured put that's already up 54%. Between that, BNMR shares, and cash-secured puts on Hood and Palantir, she's booked nearly $5,500 in the last month. Inside my Patreon, you get real-time trade alerts with entries, exits, and the full why behind every move. Daily market breakdowns so you know exactly what matters and what's noise. The exact momentum strategy I use to scale positions and manage risk in real time. It's $30 a month. People blow that on coffee and Uber Eats without even thinking. This could be the one thing that actually pays you back. You want to know if it works? My accounts are up over $2.29 million in 2025 with a 65.64% return year to date. And it's only August. This isn't theory, this is execution. Try it. If it doesn't sharpen your strategy, grow your account, and give you more confidence in every investment, cancel anytime. No pitch, no pressure. But if you've been watching my channel, nodding along and telling yourself I should join, then it's time. Stop watching, start building. Because the truth is simple. You can scroll or you can scale, but either way, don't say you weren't told.